Hello, everyone. Joe Mass here. Hey, it's March 10th, and I just wanted to give you a quick review of the markets and what we're doing and what's going on here. So let me just walk you through and get you caught up. So first of all, there's always something, right? We've been talking about this for a long time, that every year and every decade has some type of event that's going to roil the markets. This year, what do we have? We have Russia invades Ukraine. We have the Fed. We have risk and inflation. So let me walk you through each one of these points real quickly. Starting with Russia and invading Ukraine, we first of all, nobody knows what's going to happen. I don't know the end game. We're going to just have to all wait and see. But looking at history, we can see that by the invasion, right? We can see that during these other conflicts that the market usually sells off, and then 3-4 months afterwards, it still has a pretty positive trend. So again, no guarantee that this pattern continues, but even in 2004, we can see that the market did dip, it sold off, and then it continued upwards. So there is some evidence that we might be able to have positive returns here in a few months, but right now we don't know. There's a lot of uncertainty. We'll talk about that further, but I just wanted to show you this slide. It is interesting to see that in the past conflicts, the market did sell off and then did recover in short order. Okay, so let's look at the Fed. As we know, the Fed is going to stop its bond purchases here in March and then begin to raise rates. Now, at the beginning of the year, we were expecting them to raise rates about 7 times. With the Ukraine conflict, it kind of acts like a rate increase, and so we may see 4 or 5 increases this year instead of 7. We may see a quarter point raise instead of 50 bips. We'll have to see. We don't know, but the war kind of acts like it gives you the same effect as raising rates. And so the Fed's going to have to reevaluate what they're going to do. I think the Fed thinks that they're behind the curve, that they've acted too slowly. So they may be sticking to their guns and wanting to correct that error. Of course, they're never going to admit that that was an error, but the war does add another piece of complexity to what the Fed is going to do. But again, this month, we're expecting those bonds to stop and rates to start coming up. When we look at risk, right, here's the VIX, the risk, the fear index, and you can see that currently we're about 32. And what does that mean to you? Not much. It just means that the risk is back in the market. You can see that the 20-year average here is just about 19.96. It's kind of hard to read. The risk in the market is higher than what we've been seeing, and that again, that is because of the Fed actions, the Russia actions, the geopolitical events on top of the shifting of the fundamentals in fiscal policy. So what does that mean to you? Well, what that means is that we're expecting right now about a 2% move up or down per day. So when the VIX is at 32, that lets me know mathematically that the market is expecting to go up or down about 2%. So this chart is showing the S&P 500, the daily movement, and you can see the green line is a one move up, and the red line is a 1% move down. So as of today, it's about a 1.35% movement down. And again, it's within what we're expecting. So the difference between the consumer or average investor, a professional investor, is that we are expecting this movement to be there. We know it's going to be there. We just don't know if it's going to be up or down. And again, you can see that there's 3 or 4 really bad days in the market, and then there's one of the best days ever. So we're going to see that we have to be patient. But what is that? I'm just trying to show you that volatility means that we're expecting that market to go up and down about 2% a day. So don't be surprised and shocked when you wake up and you see on the news that the S&P 500 is down 2%. That's kind of what was expected. Or again, if it was up 2%, that's kind of what we're expecting right now when that volatility measure is at 32. So that's how you read that. When it comes to inflation, the orange line is the PCE annual inflation rate, and it's obviously high at 6%. The University of Michigan 5-year outlook is 3%. And the Fed still has their target at 2%. So inflation is obviously here. I just put gas in the car today at over $5 a gallon. So there's no doubt that we have that inflation, and the war has exacerbated that. The blue line is the unemployment line. It's at a very low rate at 3.8. And so again, a lot of people are working, more people are joined the workforce. That means there's more money. That means that can be more inflationary. So this is not new news. We've been talking about this for several years, and we update you this every quarter. But again, the inflation is here. Now, some people think that the inflation may even go away, or that there's deflation. And there is an argument for that I'm not going to get into today. Right now, we're going to still stick with the inflation, but we wrote an article, we put it out here a couple of days ago. We are talking about the spread between the 2-year and the 10-year is potentially indicating, a recession. And again, we could see some deflation, but we won't talk about that today. We just want to point out, obviously, that inflation is still high. Okay, where does this leave us? This slide here I've been using for the last several months. I've been doing this for 30 years, and this is one of the most difficult times that I think investors are facing, because on one side of the coin you have risk, and on the other side of the coin you have inflation. And we have clients that are really worried about risk, and so if you're worried about risk, you're going to go to cash, you're going to go to bonds, risk off assets. However, those risk-off assets in this high inflationary period produce negative real returns. And so if you go to cash, you're going to be guaranteed to lose money because of inflation. So for those investors who are worried about fighting inflation, right, you have to be in equities, value, energy, right? And of course, if you're in equities, you're going to be subject to the volatility. So it's really a difficult emotional period for investors. And so what do we do about it? Well, we're managing all of our different portfolios, and we're really trying to hedge the best as possible. So we're trying to, in some of our portfolios, we're shorting the market and we're long at the same time. Some of our portfolios, we have cash, but we're also long at the same time. So we are going to do the best we can with each one of our portfolio mandates. But really what I want investors and clients to look at here is, and we'll talk about this on the next slide and wrap up with it, is reevaluating your cash level if you're comfortable. So really quickly is that if you ask me, are equities going to be higher 3 to 5 years from now? I'd say, yeah, probably. But if you ask me from 3 to 5 months from now, it's like, well, who knows? So again, we'll show you what to do here. But I just wanted to point out that there is a battle between risk and inflation, and the way we fight risk is going to be bad for inflation, and the way that we fight inflation is going to be, bad for fighting risk. And so investors are just going to have a really hard emotional time deciding, do you want to manage risk more than you want to fight inflation, or do you want to fight inflation more than you want to manage risk? And so we're just going to rock in a hard spot right now as investors, okay? And it's going to be emotionally difficult. Okay, so on this slide, let's talk about building your portfolio. So when we build a portfolio, we're looking at 2 objectives and 5 constraints. So an investor's objectives are, what are your risk and return objectives, right? How much return do you need? How much risk are you willing to take? And so, we look at that through your lifestyle return benchmark or your required rate of return to determine the return that you need. And then, you take some type of on-point risk test or questionnaire to determine if you're, want to be, conservative, moderate, or aggressive. Then we have constraints, your time horizon, taxes, liquidity, legal, and unique. And so what investors need to do is that if any of these objectives or constraints have changed, please let us know, and then we can rebalance the portfolios appropriately. We have portfolios that are doing very well. Our metals portfolio is up 35% for the year. Our sailboats are basically at 0 to 1. So each one of our portfolios individually is doing what it's supposed to be doing, but that might not be good enough for the investor. So again, if your time horizon has changed, this is really a big one. Again, we're not building portfolios for, 3 months and 3 weeks. These are long-term portfolio objectives. So if you can't sleep right now because of the risk in the market, then we might need to increase your underlying cash position, not inside of the strategy that we're managing, but at the portfolio level. And we can do that very easily for you. So just let us know. So understanding your time horizon and your liquidity. This is another one that I want to touch on. I think investors should have enough liquidity so that they're not worried about their money that's in the market, right? So whether that's 3 months for some, or 6 months, or 2 years, or 3 years, or there's not a right or wrong. It's whatever liquidity makes you and your family feel comfortable, then we need to have that liquidity there so that you can then take the risk where we're supposed to be taking risk. And that's kind of how we're hedging, right? We have enough cash to fight risk, but we don't have so much cash that we're not fighting inflation. And we have enough risk, risk on investments that we're fighting inflation, but not so much that we're taking too much risk on the other side. So if any of these have changed, and we'll wrap up with this in a few minutes, but if any of these have changed for you, just let us know and we can remix the portfolios that we're using. So what drives the market? You hear me talk about this a lot: inflation, interest rate, corporate earnings, and the Fed. So I just want to touch on a few of these. The markets right now do not like the uncertainty, right? The geopolitical events, the war, COVID. The markets are not happy. They don't know what to do. They're trying to find their way, and hence we have the volatility. On the technical side, all of our technical indicators are suffering, right? The short term, we're definitely in a pullback. And again, how long this lasts, nobody knows. I'll show you some evidence that we think that the second half of the year is going to be better than the first, but again, we don't know when that'll turn. The positive of that is that the valuations have improved, so stocks do look attractive. Okay, barring a recession. I wrote about that in a piece I sent out here recently. That again, the spread between the 2-year and 10-year Treasury bond does indicate that we could be looking for a recession sometime over the next 18 months. But all in all, valuations, right, when the market goes down, that means there's more value in those quality stocks. And so we are holding quality stocks. So although some of our technical indicators have said we should maybe go to cash a little faster, when you look at the quality names that we have in the portfolio, it makes us want to slow down a little bit, because again, when the market can rebound quickly, and if we're not there, we miss that up. So it's really, again, trying to find the right balance of hedging your portfolio. And then, of course, the war, right? The path forward remains uncertain, and we just don't know. We'll just have to keep monitoring everything. But let's look at that valuation. So here's the S&P 500 in what we call the earnings yield, which is just the inverse of the price to earnings ratio, which is a valuation metrics. So you don't have to remember all of that. All you have to remember is that higher value is better. And right now, we're at 2.82, where the average since 1980 has been at 0.3. So this really looks like, a good call on the valuation. That gives us hope that the fundamentals will prevail and that we'll have a positive outcome by the end of the year. So they are looking attractive. Now, I'm not saying that we should go out and just buy right now today, but all in all, the valuations are looking attractive. When we look at the average PE, again, this is we inverted the yield curve, so now we're back to the PE ratio looking forward, and you can see that it's been starting to come down. And here's its average of 17.21. So we're still a little bit about average, but you can see that value is coming back into play, and so that's a positive thing. Now here, what we do is we're looking at the technical forecast. So what the Gann Mass Pressure Index does is we went back and we're looking at, although we always say that the past is no predictor of the future, we always want to look at the past to see what it might look like going forward. So what I do here is I take the last 6 years of the market, I take the daily averages, and then I use that to forecast the returns for 2022. And so the blue line down here represents what the market might look like if it followed the trading patterns of the last 6 years. And so this is a good picture because it does meet with our fundamental case. And so here we'll see that it did call for a pullback in March, and we're seeing that. Okay, again, this blue line was created before the year started, and you can see that it's matching up pretty well. Now, there's no guarantee, of course, but we would expect that the market, once the Fed raises rates and announces that it's stopping buying its bonds, that the second half would be a little bit better. And so this chart here shows that although it's going to have up and downs, right? There's never a straight line, but that general trend to the end of the year does look like a positive slope. So no guarantee, of course, but we do have technical forecasts that match our fundamental forecast of valuation, so that gives us a little bit of hope. Okay, so what to do? I know half the time people say, Joe, we trust you. We know that you know what you're doing, and that brings us great comfort. We don't understand most of these charts and graphs, and so just tell me what time it is. What do I do? So what I want you to do is I want you to hold enough cash to make you comfortable. And you may be there, you may not be. I want you to evaluate your time horizon and your other factors that we talked about, those RRTTLLU. So your return, your risk, your time, your taxes, your legal, liquidity, and your unique circumstances. Okay, so reevaluate those. And if you need to, communicate those changes in your objectives and constraints to us so that we can rebalance the portfolio to make sure that you are where you want to be. Again, you don't have to worry about the portfolios. They are where I want them, and we continually monitor and adjust those. So you don't have to call and say, hey, I want more cash and focus growth or less, or I want the sailboats to short more. I've got you there. I just want you to look at your own situation and make sure that you're comfortable with how you're positioned. And if you're not, then we can make those changes. And then again, right now, I think we need to be patient. There's so much uncertainty. I can't try to outguess or outmanage the portfolios, right? We have to be patient to some degree, and we know that that's paid off historically. So, again, I think COVID is an example, even though I don't think this is a COVID-like pattern. People that, we were pretty patient. We made some changes. We protected some losses on the downside, but we were patient, and again, it did recover. So again, in the middle of the fight, it's uncomfortable. There's volatility. It looks like there's no end in sight. But 3 to 5 years from now, I'm pretty hopeful that equities will be higher than they are today. So we do need to deploy a little bit of patience. So that leads us to, what does synergy do, right? Well, like I said, we're not trying to overmanage. We're trying to be reasonable, right? We're building reasonable portfolios with reasonable risk, with reasonable returns over reasonable time periods for reasonable people. So we're not trying to change every day. We need to be patient as well. So we're going to continue to monitor and adjust the portfolios as we have been. And again, we're happy with how all the portfolios are working. Of course, we never want to have the markets down, but we understand and we're positioned well. And then, of course, we want to communicate like we are today and continue to communicate what we're doing so that you can feel confident that we're paying attention. So again, nothing that needs to be done. If your objectives and constraints haven't changed, you're fine, and we'll continue to do our job. Again, patience is going to be deployed on some portfolios more than others, right? So the portfolios that have more growth in them, that are designed really for 3 and 5 and 10 year time horizons, like the hedge funds, those we're going to have more patience with than some of the other portfolios. So anyway, that is all I had. Thank you very much. We appreciate you. If you have any questions, just reach out to us, and we have a great team that stands ready to serve you. So with that, we pray for the Ukrainian people. We're praying for the Russian people. We're praying for all of you, just to have a peace and that the world will continue to move forward in a positive way. So thank you so much, and we appreciate you.